Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 439. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right. I think that we are passing our 13-year anniversary.
It was...
We're right at it.
It was September when the very first Financial Procast, I almost forgot what it was called, episode...
That other podcast
was recorded and released. I mean, if we call it different name, but it was basically a continuation of what we've been doing all along. So, podcasting about the esoteric world of finance and life insurance, which is sure to be an enthralling and captivating podcast that, as you can clearly imagine, fives of people tune into every week.
Well, I mean, I can see the entire history of our downloads, and it looks like a flat line. So, that's... I think we maxed out our listens a long time ago. That's like every time an advertiser contacts us about advertising, we're like, I don't think...
Get the money up front. Get the money up front.
We don't do a per 1,000 download rate. More of a flat rate.
Hey.
That's why you've never heard an ad on the podcast.
Our listenership is an exclusive group of discerning individuals.
Mm-hmm.
Those are all buzzwords for very, very small.
That's right. It's niche. It's a boutique podcast. Our advertising revenue could maybe pay for ice cream at a really cheap place.
Oh, that might be worth it.
Yeah.
So now that we've gone through all of the reasons you probably should tune away, let's try and keep you here by talking about a very fun and totally not niche esoteric topic.
Yeah.
It goes by the name of premium finance.
Yeah, which we've talked about before.
No, you're not supposed to tell them that.
Oh.
This is the first episode. Or actually, no, do tell them that. That way they go back looking for past episodes and they'll listen to more.
Yeah. Well, I mean, this has a new twist, so.
It does. And you're going to tell us what that twist is.
The twist is we told you so. No, I mean... We
kind of did.
We're like most people that do anything media adjacent. We'd love to come back and tell you when we were right about something. So,
absolutely. And when we're wrong, we'll never talk about it again.
The Bondex. I was right. It just took like 11 years. It just took a long time. So, well, I guess the sort of impetus for this episode was the fact that we saw
another lawsuit filed? Gee, what a surprising world.
Yeah, another lawsuit filed related to premium finance. Best we can tell, this goes back a couple of years at least.
Yeah.
When the original suit was filed. And there's been some updates, though we're not sure exactly what those are. They're not disclosed fully, but we can see dates of things happening.
Well, there's a few different things going on, a number of lawsuits. We tried to get our arms around like what's the totality of this, which is incredibly difficult to do. They're just popping up here and there, as we kind of thought was going to happen as time went on, because a number of premium finance presentations said things that we looked at and said,
I heard presentation. My internet decided it was going to give up the ghost. But I'm sure whatever you said was really enlightening.
Oh, I did a weird pause, so you probably heard everything you were supposed to say. No, what I was saying is that we sat through it or saw a number of premium finance presentations where they said things that you and I looked at and said, wouldn't do that.
Yeah. And if I were going to talk about premium financing, I definitely wouldn't present it that way.
No. But given the renewed supply of premium finance lawsuits to talk about, we wanted to revisit the subject, especially since there is one that, as you mentioned earlier, has been going on for a few years now. And the uniqueness about it is that it's taking place in New York State.
Yeah.
And the reason that is so noteworthy is because New York passed a law. They create a regulation that really puts a much, much more significant rule in place regarding how insurance agents make recommendations to clients, potential clients, whatever have you, and puts a much stronger requirement on them to document what they're talking about and justify it as the truly best recommendation they can make for this person.
Right.
And if they don't do that, if they don't follow those rules, there are penalties.
Yes.
So there was a decent amount of hubbub about one of these lawsuits that we're looking at today that really started to question, well, how will Reg 187, as it's called, play out in this situation? And the answer is really nothing. But there are interesting aspects of the litigation to discuss, in large part because this keeps going on. It's not a lot of it, I don't necessarily think is new since the last time we talked about it with respect to the insanity of what has been pitched and what has gone so horribly wrong. Mm-hmm. So even though we were talking about it, in some situations, I think the damage had already been done because the premiums had already been financed.
Right.
What will be interesting in the next couple of years is if we start to see even more complaints and litigation come out after, let's say, like 2022, 2023, as we have been discussing this and saying, don't do this.
Right. Well, let's, why don't you give them the 90-second version? Because there's probably some uninitiated people that are listening. We may have picked up one or two new people along the way.
Yeah.
And we certainly lost more than that, probably. But why don't you explain to them what premium financing is?
Yep.
And why. I'm going to defend premium financing for 10 seconds and ask you to explain why premium financing is not the problem.
Yeah, okay. So premium financing is basically what it sounds like. Instead of paying the premium yourself on a life insurance policy, you're going to borrow money from a bank and use that loan to pay the premium.
Right.
And
that doesn't mean you go to your local bank and borrow the money.
No.
It's a specialized sort of thing.
Yeah.
It's packaged.
In general, the arrangement is the bank is involved in the purchase insofar as they've already been lined up, they've already underwritten the insured for financial reasons, and they've already decided, yes, we can give them the loan so that when they go to the insurance company to buy this policy, which is large, they have the financing already lined up to write the first check for the premium.
Right.
Now, you said, explain why you would want to do this. It's getting harder and harder every day to stand on this hill. But
premium financing's been around for a long time, but it ebbs and flows.
Yes, it does.
And the lawsuits inevitably follow the flows.
Yeah.
So
the concept here is, if you are going to buy a large death benefit policy,
just give them numbers. Give them like
If you're going to buy a large death benefit policy, let's say it's going to be like a $50 million death benefit whole life policy.
Right.
You're probably realistically looking at a premium that is many hundreds of thousands of dollars.
Right.
And if you're older, possibly $1 million+.
Right.
And so you look at that and you go, I don't want to do that. So what you could do is you could borrow money. And what that does from an out-of-pocket cost to you, at least in the beginning, is substantially reduce the amount of money you're going to have to hand over in order to buy life insurance.
Right.
In the same sense that it would significantly reduce the amount of money you got to hand over to acquire a number of things in financing. Right? Like on a much more smaller scale, if you want to buy a $500,000 house and you have $500,000, you could write a check. But if you don't want to write a $500,000 check, you could borrow the money, and the amount of money you're going to hand over in order to acquire the house is substantially less than $500,000.
Right.
The same principle is at play here on a much larger scale, but for an entirely different asset. And that's where it gets a little weird. So if you are in need of a large death benefit, we're talking tens of millions of dollars, or in some cases, $100+ million. And it's permanent life insurance, going to be mightily expensive in most cases. And most people, when presented with that kind of premium, go, that's a lot of money. And so premium financing...
Mind you, these are people that could pay the premium.
Yes. So
like that's a big, a big part of it.
Yes. Premium financing is introduced as a way to acquire the death benefit that you want or need without having to lay out the cash that the insurance company says you must pay, at least right now.
Yeah.
So the bank lends you the money and you use that loan to pay the premium, and your out-of-pocket cost in most cases with premium finances is going to be servicing the debt that's now created. Though there are some Looney Tunes who think there's a way that you can do it without any out-of-pocket cost, which is utter ridiculous. and you shouldn't ever listen to those presentations. But in general, your out-of-pocket cost is going to be the interest accumulation that needs to be paid on the outstanding loan that you are acquiring from the bank.
Yep.
Now,
additionally, you typically will have to post collateral.
Yes, correct. Because when you buy a whole life insurance policy, the cash value that will be associated with that policy isn't going to be 100% of the premium.
Right.
So the bank says, well, wait a minute. We're not going to give you $500,000 as a loan and use the life insurance policy as collateral if the life insurance policy only has $100,000 of cash value in it.
Right.
We're going to need $400,000 of more collateral in order to make this work.
Yep.
So when you have assets that would command a $50 million death benefit, you generally have assets that you would be able to post as collateral to satisfy the bank's requirements.
Yep.
So you do that and things move on. The good news is you've posted collateral, bank's happy. The bad news is it is an encumbered asset, which means you can't just do whatever you want with it.
Right.
So if you wanted to sell the asset, you need the bank's permission to sell it. And generally you need to come up with some other form of collateral to keep the loan satisfied.
They'll say, yeah, that's fine. What else are you going to post for collateral?
Mm-hmm.
As soon as you post that, we'll release this other.
So all of this is basically the fundamentals. And when it works the way you expect it to, most everything is fine. The problem comes up when people make bad assumptions or are sold premium financing in a way that is pretty much fiction. And the real implications start to come home to roost. What I mean by that is, let's say the cash accumulation of the whole life policy is not as fast as you thought it was going to be.
And a lot of IUL is used for premium finance.
Yep. Okay. Yep. And, or that's a much better example because IUL is going to be much more variable in terms of how much cash is going to exist in, let's say, 5 years from inception.
Right.
Whereas whole life insurance is a little more predictable. So if you use index universal life insurance for this, and it turns out your indexing credits aren't quite what you thought they were going to be at 8.5% assumed per year and every year, you end up 5 years down the road and find out that, well, I don't have as much cash surrender value in the index universal life insurance policy, so the bank's calling me asking for more collateral.
Right.
Which can be frustrating to possibly deal breaking.
But that's not a tragic scenario. That's just an inconvenient scenario for most people.
Yeah. The other problem is when we start to look at interest rate assumptions, and interest rates charged by the bank don't hold to those assumptions when they're optimistically presented to you. What I mean by that is, let's say you go to borrow the money initially, and interest rates are in a position where you borrow at 3.5%. And
as happened 5 years ago.
Yeah. And all of a sudden you find yourself in a position where the loan resets and now there's a new interest rate applicable, and that happens to be 6.5%.
Mm-hmm.
That's going to make the cost of carrying the debt much more substantial.
Right.
And
because typically, at least most of the ones I've seen, the rates were fixed for 3 years or 5 years or something like that, and then they float.
Mm-hmm. So understand this. When it comes to signing up for premium finance, there's a lot of assumptions that are made at inception. And there should be a significant amount of critique of those assumptions and or contingency plans for a range of where interest rates will go.
Right.
And the acceptance that could happen and the ability to deal with it when it does, or if it does.
And remember, you got two sets of interest rates. You've got the interest that you earn on the policy itself, and you have the interest that you're being charged on the loan.
Yeah. When those steps get skipped, you set yourself up for a very, very ugly situation where suddenly carrying the loan becomes wildly more expensive than you thought it was going to.
Yep.
And that is an extraordinarily unfavorable circumstance.
Mm-hmm.
So on its face, premium finance is sold as a way for wealthy people to leverage and basically get discounted dollars. So they can buy a big life insurance policy for way less money out of pocket than it would otherwise cost them.
Yep.
That's usually the way it's presented. Now, that's the beginning of the story. The part that every agent likes to leave off is that, like most financing usually works if held for a while, it will end up costing most people more money to buy life insurance that way.
Yeah.
It just will. So
the
acceptance,
when you have two sets of interest rate assumptions, this is going to be very esoteric, but there will be one person, you, that understands what I'm saying. The longer you go with two interest rate assumptions in any sort of deal that are working, maybe they're working together, maybe they're working in opposition to one another. Hard to say. The greater the divergence becomes over time from your original assumption.
Yeah, because if they don't both work perfectly the way you want them to, then every time they both move in the opposite direction against your favor, it's going to augment the negative impact of results.
Yes.
Yeah.
Compound interest works in both directions.
Right. Now, if they both move more favorably in your favor, more favorably in your favor, listen to me today.
Yeah.
That also compounds the goodness. I'm just going to keep doubling down on English. So
more better.
There's that. It can get more and more better. But unfortunately for premium finance, that has not been the way it's gone for anyone that we're aware of.
I've not seen it. Yeah.
So the problem that we saw years ago was that interest rates were low and the likelihood that they were going to remain low seemed also low.
Yeah.
And when interest rates began to rise, it was going to much more stress the viability of in-force premium financed life insurance. The reason being, most people intend, after a while, to use the cash accumulation of a life insurance policy to retire the loan that they take in order to reduce the expense of financing the life insurance policy.
Right. Now, so they're going to take a loan from the policy to pay off the loan at the bank.
Yeah. Yeah. Now, this all on its own puts a lot of people in a very, very precarious situation. But we'll skip that for a second and just point out that if that's your assumption, the accumulation of cash value in your life insurance policy kind of has to stay on track or do better than you're thinking. It also means that the interest accumulation of your other loan, from just a cost standpoint, can't really go beyond what you think it's going to do unless you've planned for that. What has happened is, one, we saw interest rates kind of stay a little bit lower, and that impacted the growth of cash in a lot of life insurance policies. But then we saw a rapid rise in interest rates, which did not immediately positively impact cash accumulation of life insurance policies, but it absolutely impacted the movement in interest rates on outstanding loans that had been used to finance those premiums.
Yep.
So the cost of borrowing...
Full circle to the lawsuit.
Yeah. The cost of borrowing went up, but the benefit of cash accumulation didn't really go up with it.
Right.
Which was in some cases suggested would be the circumstance among various insurance agents.
Mm-hmm.
Now, even worse yet than all of this, because ultimately the layout of premium finance and its viability, which is really kind of weak at best in most situations. Again, really good way to acquire a large death benefit at a low initial out-of-pocket cost. Right. So if we understand that and we're okay with that and that alone, then premium finance has viability. But beyond that, this idea that, well, you just kind of let the loan linger for a while and everything will be okay, that's a really bad strategy.
Yeah.
It's just a really bad strategy. It should be more of a situation where, I do technically have the assets to buy that. I just don't want to liquidate them today. So I could use premium finance to significantly reduce the cost of buying the policy that I want, need, whatever it is, getting underwritten, which could be a problem in a few years, getting the policy put in place.
Right.
And then I'll liquidate those assets, pay off that loan, and just start.
I know I've got a liquidity event coming in the next 5 years that's going to retire all of that.
That is the best application of premium finance. But that's usually not the way it's presented or sold.
And we've known some people who are, did a lot of it and were responsible about the way that they did it.
Mm-hmm.
And to a fault, every single one of them always says the exit strategy has to be known from the beginning.
Yeah. Yeah.
It has to be solid. It can't be theoretical.
Right. So
if you don't know that, then you don't do it.
Right. The big problem is that premium finance started to be presented in two really horrible pitches. One was cash accumulation, which was just ugly, bad, and seemed utterly insane. The other one...
Now you've thrown all sorts of other variables on top of the variables.
see how premium finance works. The other one was basically telling people, look, you can buy life insurance for less money than you think you would need to pay, and I'm going to show you how. And that's, again, for a little while, possibly, but not forever.
No big deal. After 10 years, you're going to owe the bank $1 million, but you're going to have $3 million in cash value. And
right. It turns out it doesn't work.
As if it's a certainty.
Yep. Yep. So that is where we started to get really, really, really cold on premium finance.
Yeah.
And listen, we've been in the insurance industry for a long time. We've got a lot of wealthy clients. We have been forwarded emails that they have received as solicitations to buy into premium financing. And we have rendered an opinion, which has been thumbs down on every single one of them.
Yep.
And this was not our suddenly rushing in to say, no.
They've sent us the proposal material.
Yep. And this was not our moment of saying, no, don't do that. Do this with us. No. It's just full stop. No. Don't do that. So the problem with trying to finance life insurance in this fashion, which is where a number of these lawsuits start to originate. This idea, one that's either for cash or it's just this, you could save so much money by just borrowing the premium. It doesn't work because life insurance as an asset isn't designed to grow in a way that makes borrowing money to buy it indefinitely a good idea.
Yeah. Has a pretty linear growth pattern.
And a pretty limited, like we know what it's going to be. It's not going to be the case that some magical event takes place and all of a sudden we have 3 times the cash value we thought we were going to have 5 years out.
No.
Or even 20 years out.
If that's happened to you, please contact us. We'd like to see. That's not generally how it works.
Right. No. So these people who were sold this idea buy in under extraordinarily shaky pretenses. None of it pans out the way they were promised, and now they're upset. Understandably so. And there are a number of lawsuits that have come about in the past couple of years where exactly something like that has taken place.
It's very, I was going to say that there's a very recognizable pattern.
Yep. This one in New York involves a couple who used premium financing more so to buy death benefit, for sure, big death benefit, like $150 million death benefit.
Yeah.
And the agent basically told them, look, you're going to borrow $1.5 million. Or excuse me, I think it was more than that, but you're only going to post $1.5 million of collateral. That's it. It'll never be more expensive than that. And I believe the complaint totals the borrowing and expenses up to like $7+ million. They started out with a 2.5% interest rate assumption. They're now over 6%
on the loan.
Yep.
Yeah.
So life insurance cash value has not grown quite the way that it was promised to, but the loan balance has grown wildly better than it was promised to.
4 times.
Yeah. And that's created a pretty substantial litigation situation against an agent and several insurance companies. And the excitement about that with respect to New York Reg 187 has been kind of a nothing burger since to our best investigative capabilities. We don't see any indication that the state of New York has attempted to investigate the situation or bring any sort of recourse against the agent. So we don't know what will ultimately happen because this is still pending litigation. But we obviously have some people upset enough to file a lawsuit.
Yep.
And there are more recent...
And it rhymes with about a half a dozen others that we've seen in recent years.
Yep. And there are more recent ones. I don't remember what state this one is in.
Didn't one of the sources that we had on this talked about the fact that the buyers of these policies questioned the variable nature of the loan, right?
Yep, they did. They asked, like, if interest rates go up, what's going to happen? And the agent, the allegation is the agent said, oh, dividends will go up with those interest rates, so you don't have to worry about it.
Dividends have gone up.
They have. I'm not speaking to the specific agent, the specific situation, but I can tell you from other presentations that we have seen, that's been the sentiment.
Yeah.
Don't worry about it because these products are going to move in lockstep with interest rates, which they move with interest rates, but lockstep is kind of the key term that's a little wrong.
And dividend rate is not the same as an interest rate. So.
No, it is not.
Which you'll have to go way back in the archives to listen to those, but
right,
we've talked about that dozens of times.
Ooh, that's a really good way of getting them to go back and listen to past episodes. Not that it helps us. I don't know why I care. But
well, in recent years, we haven't had to talk about it because insurance companies don't talk about their dividend rates because they haven't been as awesome as they used to be. So
yeah.
Nobody wants to say we got an 8.75%
dividend rate. Interest rate. Yes.
Yeah.
Another situation which is super duper sad. I don't remember what state this is in, but there was a one filed recently for premium finance where somebody 1035 exchanged like $600,000+ of cash into a policy and premium financed it, and ended up paying like $100,000+ of interest on the loan. Then tried to unwind the whole thing and walked away with $50,000.
Yep.
And it's not clear. And that was one that we did get to look at the complaint on what the point of premium financing was in the first place.
Yeah.
Again, I want to be very clear about this. Premium finance is something that you can use to reduce your out-of-pocket cost to buy a very large death benefit policy if you need to reduce that out-of-pocket cost right now and for the next couple of years.
Mm-hmm.
That's it. It's not something that you do just because you can. It's not something that you do because you think you're going to leverage cash value. That's a horrible idea. And it's not something that you're going to do because you think you're going to buy really cheap permanent life insurance for the rest of your life.
Right.
That's the big message that I want to get across today, because I think we've not always been super clear about that as we've talked about premium finance in the past.
Yeah.
And look, I know there's a number of people out there who are going to try and go all fancy finance on me and say, yeah, but there's people who finance other assets. Like if I want to flip houses and I got $500,000 in cash, I could buy that $300,000 house down the road and pay cash. But if I go to the bank and borrow money, then I don't spend near as much money on it, and that juices my return. To which I would say, that's all fine. But unless you have like 2 or 3 other deals to be done at the same time, financing was pretty much pointless.
Right. Yeah.
There is a risk, a very serious risk involved in premium financing. So the need to reduce the out-of-pocket cost must outweigh that risk. And
I'll go back to something I said a long time ago that a mentor told me. It took me many years to understand what he's talking about, because when I first heard this, I was very young and uninitiated, uneducated on all the moving parts. The people you should pitch premium finance to, this was what the person said to me, are the people that could afford to pay the premium if they weren't financing it.
Yeah.
So it's just a choice for them.
Right.
So that way, if they get into a situation 3-4 years down the road where interest rates go from, what'd you say, 3.5 to 6, 6.5, and what was a great deal 5 years ago is no longer a great deal, they can unwind the thing.
Yep.
And it didn't cost them any more. It was a wash basically for them at that point, because they were going to have to pay it anyway.
Yeah. I do want to be very clear about the fact that inside the world of premium finance is this idea of leveraging for cash. So you pay some of the premium.
It's a relatively newish idea.
Yeah.
In the last.
You pay some of the premium, but then you borrow the rest of it as a way to enhance the cash accumulation of your policy. No. Nope. No. Don't be dumb.
Someone's going to say, but Brandon, I can show you on paper where it works.
Good for you.
To which you could say, well, I can make up numbers and put them on a spreadsheet too, but that doesn't make it true. So.
Look, we've had some people come to us like with these presentations, these ideas. We've even had clients do it, and we've told them, no, don't do this. And they did. And I don't know of any of them that worked out great.
No, I know they didn't because they never called us back to tell us how great they worked out. Generally, when people don't want to talk about things.
No, people unwind them. People unwind them at a loss. The world of speculating where a life insurance policy is going to be 5 to 10 years from now there's a range
coupled with where interest rate's going to be 5 to 10 years.
But if we're starting to do that also with the idea that we have to control what banks are going to charge, because there's no connection to the two, right?
Right.
Nope. Insurance companies are not going to raise dividends or cap rates on index products because the bank's raising its interest rate. And the bank's not going to keep its interest rate low because it lent you money to buy life insurance that's not keeping up with. Those two things don't work collectively with one another.
That's right. So, that's like going to your boss and saying, this job just doesn't pay enough.
Right.
Your boss is going to say, well, I suggest you find another job then.
Or stop spending money. One of the two.
I mean, it is what it is.
Yep.
The job pays what it pays. So
I've said this before and I'll say it now. I don't know why you would take something that is supposed to be a super safe asset, life insurance, and subject it to a substantial amount of risk by trying to finance the premiums for cash accumulation.
Are you asking that as a rhetorical question?
Yes, I'm very much
okay. I was about to say.
Unless you feel like you want to give me an answer.
Well, I'm channeling the insurance agents. I can tell you what's in it for them.
Go right ahead. We need to.
Well, $1 million premium is a lot more than $100,000 premium.
Yes,
so.
This part is very true. This part's very true. There is a financial incentive to convince you that financing a bigger premium is good for you.
Yeah, and the complexity of it all makes it seem super special.
Yes, and there is
it is complex, by the way.
There is one other thing about this, and it's an observation, a very astute observation you made years ago to me, that explains why all of this exists in the magnitude that it does. And it's very unintuitive, especially for lay people.
Yeah.
But the reason all of this has been so heavily pitched and sold, unfortunately, is because of estate tax.
Yeah.
Because years ago, the estate tax threshold, the exemption was much lower. And so all of the agents that are pitching premium finance used to just pitch ILITs for avoiding estate tax.
Yeah.
But since that business has been wiped out for a huge percentage of the population, they need something else to get all overly complicated about. And premium finance is where they went.
Yep. I think when I started in the business, my memory is correct. I could verify this, but I think the exemption for the estate tax exemption, as colloquially known, was $675,000.
Yep.
Which means anybody that owned an ice cream shop was in trouble.
Or a house in a nice suburb.
Yeah.
And a 401k. It was
right.
It was much easier to get trapped.
Yeah.
Now it's 13 million.
I was thinking 15 for whatever reason. I don't know. It's irrelevant. That's why we don't know. For most people,
it grew way faster than the rate of inflation.
Yep.
So the number of people who have a liability is not large, and even if you have a liability, if it's $1 million liability, it's not ultimately a big tax.
Right.
So the need to buy life insurance in an irrevocable trust is less than it once was.
Right.
And that
to go through all the complexity of managing it, the cost to set it up, the cost to manage it ongoing.
Yep. That sadly opened the floodgates to a group of people trying to still sell big premium life insurance with a different twist.
You're saying this is the new islet?
It is.
Supercharged.
And it's even bigger. And unfortunately, bad things can happen, whereas buying in an islet really wasn't such a potential problem.
Right. It was premium financing was big, sort of pre-2007, kind of in that. I remember hearing about it a lot back then. Then we went through the financial crisis and no banks wanted anything to do with it.
No, but as we got out of that, it started to become
and then it heated back
topic
up
again. Yeah. And then some of the uglier stuff that we're talking about today really started to take off as we got into the 20 teens.
Yep. And it used to be very limited. There weren't that many insurance companies that wanted to deal with it.
Mm-hmm.
And even the few that this is my recollection, the threshold limits for net worth were quite high for them to even consider allowing you to do it.
Yep.
And in recent years, we've seen lots more companies be willing to do it, and many of them are like, they don't care about any of the limits at all.
Yeah, there are certain premium finance situations that they'll finance much smaller premiums, which is a horrible idea. All right, we'll come back and complain about something next week.